Hello, everybody. So this week I want to discuss something that I have been hearing more and more of lately. I believe there's a bunch of YouTube videos or Instagram posts or things about tax saving strategies out there. Um, so I wanted to address one of them that I've heard a lot about recently, which is buying short-term rental properties and turning them into a business in order to create large tax deductions. So the idea is that you basically you buy some real estate property, you turn it into a short-term rental for Verbo or Airbnb. Um, and because it's a short-term rental, you can treat it as what is called basically a sole proprietorship type business. However, you take a cost segregation, take aggressive depreciation, and ultimately create a taxable loss that is always and forever going to be deductible against any like W-2 wages or other business income. On the surface, this is a great idea, and it does work. However, there are some pitfalls that I wanted to address. If this is something that you do want to look into, by all means, reach out to your tax advisor and have a discussion because it is possible. Um, but the first thing I wanted to talk about in this is one of the dangers is active versus passive income. So the whole point of making it basically a sole proprietorship business is because you're trying to overcome the active versus passive rules. There's three different real tiers. There's completely passive, where basically you are really just investing money into something, and then your money's making money for you. In real estate investment, that typically means you have one or two properties. You've hired a property management company, and they're taking care of everything for you, and you just sit back and collect the rent income, less any expenses. That's truly passive. Then there's active. Active is pretty much the idea that you're running it yourself. Um, Basically, you can either say that you've put in at least 500 hours a year to manage your real estate rental properties. You can prove that no one else is putting in more time than you, or there's a couple other ways, but basically, those are the two main ones. You show you're actively participating in the management of the real estate. Active allows you to deduct losses against other active income, such as like W-2 wages or other business income. But just being active in and of itself does have what's called AGI, or adjusted gross income limits, that can still hold up your losses. Passive, true passive means that your losses get held up until you actually completely sell the property. And so they don't deduct against your W-2 wages. A real estate professional is the third level, and basically you claim that you rise to the level that this is a professional trader business, and therefore all your losses become completely deductible in the year that you've incurred them. Uh, well, one of the ideas of moving it to as a short-term rental into a Schedule C sole proprietorship business is that you're automatically active, and that's not true. You still, because it's still a real estate entity, real estate investment and rental property, you still have to take a look at the active versus passive rules to see if you qualify as being actively participating in or rising to the level of a real estate professional in the rental property. So that rule doesn't go away just because you've moved it over to a Schedule C. Another pitfall is that as a Schedule C business, income profit is subject to Medicare and Social Security tax, whereas real estate investments are not. So if you have a $100,000 profit in a Schedule E rental, you are only going to owe income tax on that. If you have a $100,000 profit in a Schedule C business, you are going to owe income tax on it and $15,000 approximately $15,000 of self-employment tax, which is Medicare and Social Security tax. So you automatically increase your taxes by claiming it as a Schedule C business. Now, the argument there is, well, I'm always going to forever show losses because of depreciation. Well, that's going to throw up a red flag for the IRS because Schedule C sole proprietorship businesses are the highest audited entity for tax filings. So the other thing is to be a trade or business, you have to have profit motive. Now that is the entire regulation, and the IRS tries to define that certain ways. One of which is you need to show profit every 2 out of every 5 years or something like that. There's an algorithm that they have inside their actual computer system that flags Schedule C's if they have shown losses for too many years. That doesn't mean you wouldn't win an audit. It just means you might cause an audit by going too many years showing year over year losses on a Schedule C. So that can become a problem. Well, then if you get audited and the IRS might determine that you didn't actually have a loss, you're then going to be subject to Medicare and Social Security tax on top of whatever they claim is taxable income as profit in your schedule or in your rental property, Schedule C. And so those are kind of some of the pitfalls you have to worry about. Now, you can still set up a real estate portfolio, take it as a Schedule E rental, and create taxable losses through aggressive depreciation that will offset your W-2 income, but you won't be subject to Medicare and Social Security tax, even if you get audited and they change it into a profitable investment. So that's typically the way I advise people to do it, is to stay in the Schedule E rental world so that you don't have to worry about that Medicare and Social Security tax. Another thing you do have to consider is the nature by which you're providing the services. What I mean by that is, in order for it to become a true trade or business, what type of services are you actually providing? Because again, if you are just owning rental properties, and even if they're short-term rental properties, that may or may not actually rise to the level of a trade or business. And that is a double-edged sword that can cut both ways. So one of the IRS has several factors that they look at. One is the average term of stay. If you have an average term of stay that's less than 7 days per stay, then that is considered a short-term rental, and it's going to be looked at for a Schedule C filing. Basically, what we're getting at here is how close are you from to a true long-term hands-off rental versus I am a hotel with concierge service. The more you look like a traditional hotel, the more you're going to be a Schedule C business. And again, this all comes back to really Medicare and Social Security tax, because that's an instant 15%, regardless of what your income tax is. You could actually show a net loss on income taxes, but because you have profit on a Schedule C, you end up owing taxes for Medicare and Social Security tax, because that's calculated on top of the profit of your business and added at the back end on your tax return. So you might actually have complete taxable losses for income tax and still owe taxes for Medicare and Social Security tax. So that is a sword that can cut both ways, is when they're looking at whether it's a Schedule E investment property versus a sole proprietorship trade or business subject to Medicare and Social Security tax. So the first one is the average length of stay. Is it less than 7 days, or is it more than 7 days? That can determine whether you're a business or a rental investment property. Other things are, like I said, how closely are you to having full concierge service? Are you constantly checking on the guests? Are you available at their beck and call? Or Are you closer to a long-term rental where you might only show up and actually take care of something if there's a legitimate like problem going on and they have to, in some cases submit a work ticket or send you a message and you're like, "Hey, I'll get to that as soon as I can because it's not an emergency right now." So or are you greeting them at the door, providing a gift basket, telling them to text you, and you're basically at their beck and call like a front desk would be at a hotel. So that makes you more of a business versus an investment property. So these are kind of the pitfalls that you have to watch out for. Now, it depends on your unique situation whether a Schedule E rental would be better for you or a Schedule C sole proprietorship business would be better for you. There is circumstances where either one of them would be better for you, and there are circumstances to which taking aggressive depreciation through a cost segregation could be better versus long-term straight line depreciation. So these are the conversations that you have to have with your tax professional. My purpose of this video was to just kind of point out that even though there are wonderful tax saving strategies out there, especially in the short term rental department, there can be some significant tax savings involved, but you do have to consider some of the pitfalls and make sure you're crossing your T's and dotting your I's. Otherwise, you're not going to get what you're trying to go for in the tax savings. Anyway, I hope this video helps everybody consider rental properties, as they can be a great way to save on taxes and basically increase cash flow year over year while paying less and less taxes. But it does have to be set up right. So have a wonderful weekend, and I'll see you next time.